Today, we're examining what could be a critical inflection point for the global solar industry. And right at the heart of it all is Tongwei, a true photovoltaic giant. Now, after a really brutal price war that has completely reshaped the sector, we're going to be dissecting the data to see if a genuine recovery is taking shape or if this is just a temporary calm before another storm. So we're going to start with our key analytical findings right up front. First, it looks like the industry downturn has hit a bottom, one that seems to be enforced by policy. Second, while Tongwei has taken a significant financial hit, its core competitive advantages are still very much intact. And third, any potential recovery is, well, it's highly contested, facing some serious headwinds from oversupply and geopolitical tensions. This framework is going to guide our entire analysis. Here's how we'll break it down. We'll start with the crash itself, then analyze Tongwei's competitive moat, look for signs of a bottom, assess the risks, and finally, lay out the key signposts to watch for going forward. Okay, first things first, to really understand any potential recovery, we have to grasp the sheer severity of the downturn that came before it. This chart just says it all, doesn't it? It perfectly quantifies the magnitude of this boom-bust cycle. You see, at the peak in 2022, Tongwei posted a net profit of over 25 billion RMB. Just 2 years later, that completely reversed into a 7 billion RMB loss. The data here shows not just a decline, but an absolute collapse. So the obvious question is, what on earth caused this? Was it some kind of strategic misstep, or was this a symptom of a much deeper sector-wide crisis? This DuPont analysis gives us some critical clarity. It basically deconstructs the return on equity, and the data here is just unequivocal. You can see that while other factors did shift a bit, the collapse was driven almost entirely by one single variable, the sales net margin. It plummeted from a healthy 18% all the way down to negative 7.6%. This right here is the financial signature of an absolutely brutal industry-wide price war. Understanding the severity of that crash leads us to our next logical question. How does a company possibly survive something like that? And that brings us to Tongwei's competitive moat. The company's resilience is really built on three distinct pillars. First is its leadership in cost. Second is its advantage in technology. And third, its unique strategic positioning within the global market. Let's take a closer look at each one. So the first pillar is cost leadership, and that all starts with polysilicon. This is the ultra-pure silicon that forms the very foundation of solar wafers. Through just massive scale and incredible process efficiency, Tongwei is the global low-cost leader. Now, in a price war, that is the ultimate defensive advantage. The second pillar is technology, specifically Tongwei's leadership in the big shift to next-generation N-type solar cells. What you need to know is that these cells offer higher efficiency and they degrade less over time. This creates sustained demand for a premium product, even when the market is flooded with cheaper alternatives. And this leads to a really key strategic advantage. As Western tariffs begin to target finished solar modules coming out of China, we're seeing non-Chinese assembly plants pop up. But here's the thing, these plants still need the most critical component, which is the solar cell itself. And as the leading producer of these advanced cells, Tongwei is perfectly positioned to be an essential supplier, which allows it to partially bypass some of those direct trade barriers. So now that we understand the company's defenses, we can turn to the market itself and start looking for objective data points that might suggest the worst is finally over. The most significant signal we've seen has been in the price of polysilicon, the industry's primary raw material. A price surge of 48% in a single month, that's not just noise. It's a really powerful indicator that the fundamental relationship between supply and demand is shifting. And that price signal, it doesn't exist in a vacuum. It's actually supported by concrete policy actions, like the cancellation of export tax rebates, which is designed to curb overproduction. We're also seeing supply-side discipline, with major players reportedly cutting their operating rates. And finally, you have this sharp divergence of opinions among market analysts. That itself is a classic hallmark of a market at a major turning point. However, and this is a critical however, we have to remain objective. A potential bottom is not the same thing as a guaranteed recovery. We have to rigorously examine the significant headwinds and the very credible counterarguments. The bear case really hinges on one crucial point, that this current price rally is just a temporary thing, driven by companies restocking their inventory, not by a real structural shift. The argument is that the fundamental oversupply problem is so profound that prices are just going to fall again once this phase is over. We can really group these headwinds into four major categories. The biggest risks you can see stem from geopolitics and trade policy, followed very closely by that persistent threat of market oversupply. High corporate debt levels across the whole industry also pose a significant financial risk. And of course, the long-term potential for some kind of disruptive new technology always remains a factor. So this really distills the central conflict. The bull case says that policy creates a price floor, allowing the leaders to consolidate the market. The bear case argues the supply glut is just too big, that it will overwhelm any policy, leading to another price war and a global market fractured by tariffs. Given all this profound uncertainty, the most logical approach isn't to try and make a definitive prediction. Instead, it's to build a toolkit of key indicators. This will let us monitor which of these two narratives is actually playing out in the real world. This framework gives us an objective way to track what's happening. On a weekly basis, we'll watch polysilicon and cell prices for a real-time pulse on the market. Monthly, we'll analyze export data to gauge global demand and any shifts in trade. Quarterly reports from competitors will paint a bigger picture of the industry's health. And of course, we have to constantly monitor for any trade policy announcements, which could change the entire landscape in an instant. And this leaves us with the central, unresolved question. The coming months are going to reveal whether coordinated policy and supply-side discipline can truly impose a new order on this market, or if the sheer force of the supply glut will pull the industry right back into another downturn. The data from our framework will ultimately provide the answer.